Purpose of this video is to give you current, accurate data on Silicon Valley real estate market so you can make better decisions on when to buy, sell, or hold on to real estate in the Silicon Valley. These are the key chapters we're going to go over and the corresponding picture graphical representation. My favorite is the micro markets, but the first ones we start off with are graphs to give you a better understanding of what happens over time. Let's get into the data. Here's a summary slide for those that like it. You have the inventory here. The concept is the same in all of them. The purple is the current data. The red would be a red hot seller's marketplace. The gray is the typical marketplace as defined as the median for the previous 10 years, not including the current year's data. The blue is the coolest you'd expect, which in the case of inventory is the most inventory. You can see we're right now very closely approaching the hottest, the least amount of inventory you'd expect. We only have 79% of that 10-year median with just over 1,000 listings. Same concept with the offers, but on offers, the low number of offers favors the buyer, and that's what we have. The least number of offers you'd expect, and we're at 77% of the offers you expect. But notice that we're at about 1,130 transactions. So you're turning over your market more rapidly, 10% more rapidly than the length of a duration of the typical escrow. The next one is the supply demand balance, seller buyer balance, the turnover rate of the marketplace. And you can see it's pretty close to normal. It's a little bit on the hot side, 91% of where you'd expect it to be. A faster turnover market is a quicker marketplace. The next slide is probably the most interesting of them all, the 75th percentile of days on market. This is how long it's taking 3/4 of the sellers to get an offer into their property. Until 5 weeks ago, you can see it was basically completely normal. And then 5 weeks ago was basically Thanksgiving, and you can see it started to increase. And it's pretty high right now. It's 30% longer time than you'd expect. It's at 47 days, which is 30% longer than you would expect it to take for this time of the year. Then we're moving down to price cuts. And this is a very small number, and that's because a vast majority, somewhere around 85% of the sellers do no price adjustments at all. And you can see that it's been very close to the normal number. It's now a little bit greater than price reductions than typical, but it's only 1.25% of their seller's S price. And these are the prices the sellers are reducing before they get their offer in. Again, the reason it's so small is the vast majority of the sellers do no price adjustments whatsoever. And then overbidding also stands out because even though the marketplace appears to be a little lethargic, the amount of overbidding that the buyers are doing when they've come in with their offer is clearly above the typical amount, and it's currently at just under 5%, and the typical amount of overbidding is 3.6%. So you can see you're getting a 1.3% or almost 33% higher overbid than you typically do for this time of the year. Now you have all three components going back over the previous 11 years. And you start with the purple, which is the inventory, and you can see you're just under 80%, somewhere around 79% of the inventory. You can see the orange line is the number of offers. It's about 77% of normal, but the speed of the marketplace is basically at 91%. So the market is faster than you would typically expect, even though the number of offers is a lower percentage than the inventory. And the reason that's possible is each one of these indicators is done independently of each other. And as it turns out, when you go back and look at the data, the median for each indicator happens in different years. That's how come this is not the DUI, the gray line, is not slightly above 100%, which is what you'd expect based on just the ratio of the number of offers and the number of active inventory. Now what we're doing is looking at one component at a time. This component is inventory. The gray line is where you'd expect the inventory to be based on the previous 10 years. The blue is the most inventory you'd expect, which favors the buyers, and the red is the least inventory you'd expect, which would favor the sellers. And you can see basically since the middle of fourth quarter, we've been right on top of the red line. So we've had limited inventory and some of the least inventory you'd expect. You can get below the red line, as you can see here in early 2022. Here is the same information where I pull out the gray line up here and make it straight, and then what percentage of that gray line is the current data. So you can see that you're just below 80%, and I think the number was somewhere around 79%. You can see that we started off much lower a year and a half ago, and we've been gradually climbing, but we're still have a lack of inventory. And it's also noteworthy, we basically have had a lack of inventory. Here was the announcement of the pandemic. Before the pandemic, we were basically having a surplus of inventory. And basically, since the pandemic, we've been having a shortage. Yes, we had a little bit of a shortage right before the pandemic, but been much more consistent. And based on the past 10 years, we're quite a bit lower than we had been before. Here's the number of offers accepted, and we're comparing it to the previous 11 years. You can see you're right on top of the blue line, so the least amount you can expect. But notice the amount of vertical separation here at this time of the year is so small. You can see the lines just come down right on top of one another, and so it's really hard to make much difference out of it. And here's compared to normal. You can see inventory was basically at 70% for most of 2023. We've been climbing and we've gotten up to basically right around 80% with some bounce, but we're still missing a good portion of the marketplace. Here's the days unsold inventory. So the supply demand balance, you can see that you're basically following the normal pattern. You were a little bit above, so a little bit cooler than normal at the beginning part of 2024. And right now we're a little bit hotter on the red side of the gray line, which is a hotter, faster marketplace. Here's compared to typical. So now you can see you're at 90%. You can see with the pandemic, we were way faster than we are right now. We were down here somewhere around 60%, 50%. So the market was almost twice as fast as it is now. And right now, you're only 10% slower. You're at 90% of the speed of the typical marketplace. Here is that long marketing time, the 75th percentile. And right here is basically Thanksgiving. This little hiccup is sort of the week after Thanksgiving. And instead of doing the correction, staying on the gray line, we took off and we're now quite a bit above the blue line. And when you go back over time, you're getting to be some of the record high numbers. And the record high numbers don't occur for typically a couple more weeks. So it's going to be interesting to see if we approach these. Well, we're already approaching these previous peaks. Are we going to surpass the previous peaks? If you start looking at the data, it looks like it's starting to round off right here on the far right side of the graph, but only time will tell where that number actually goes. Here you can see the large increase. And again, compared to typical, you're up in some of the higher numbers where you're at 30%. And I would expect it to go up. But again, you can sort of see it leveled off from last week to this week. This is now ignoring typical practices in statistics, and I'm only looking at the extreme. I'm looking at the 10% of the sellers that are taking the largest price reductions. How much of a price reduction are they doing? And they're basically only they've reduced their price to 86% of their original ask price. So that has them taking a 14% price reduction. So quite a bit higher price reductions than normal for those that are taking the largest 10% increase. And here you can see your typical number here was the amount of decrease they're typically taking. And here you can see that they're taking 20% larger price reductions than they typically do. Now, just to show people that I'm not playing around with the data, this is looking at the average price reductions. The reason I look at the 10 percentile first is the vast majority, about 85% of my data is zeros. And so I just threw it out. But if you include all those zeros, what happens is that 14% price reduction that we were seeing on the previous slide becomes a 1.2% price reduction on this slide. But again, it's a more stable index, and you can see that we are taking larger price reductions than we typically do. And typically, we'd be up here about 0.9%. Here we're just about 1.25%. So, it is a little bit greater price reduction even in the average. And here you can see that you're taking a larger price reduction than you typically do. If you were taking the typical price reduction, it'd be right on the gray line. This is frequency. So this is now looking not at the magnitude of the price reductions, but just how common is it? How common price reductions are is completely normal here, just over 20%, maybe 21% of the sellers are doing a price reduction. So that means the sellers that are doing price reductions are taking larger price reductions than they typically do. And here you can see you're right at 100%. This is the magnitude of overbidding. So this is the pressure the buyers are clearly feeling when they're going in to present their offer. And you can see that you're on the red side, the hot side of the gray lines. So you're taking bigger price reductions than you're typically doing. And this is the median price reductions. And so you can see the median is about 1.5% overbidding. The number we saw earlier in the presentation, that 4.9 number, I think it was, that was the average overbidding. So the average is quite a bit higher. And you expect that, just like average sale price is higher than the median sale price. You have those few outliers up around 20% overbidding and sometimes 50% overbidding. And that brings up your average, but really doesn't impact your median. So here's your overbidding, and you can see it's greater than normal. Here's the frequency of that overbidding. So again, you're pretty close to the normal line, but you're slightly on the hot side. So the buyers are feeling a little bit more pressure than they typically do. And this is based on frequency. So this would also suggest that the amount of overbidding is a combination of buyers overbidding a greater percentage, on their transaction, as well as a little bit higher percentage of the buyers overbidding, which brings up the median and the average. Here's the frequency. You can see the frequency's been running a little bit higher than normal and a little bit higher, maybe somewhere right around 5% for the last year or so. You can see in 2023, it was actually quite a bit lower than it typically is. Here's your long-term price on log paper, which I prefer. You can see we're having our typical V down at the end of the year. Everybody should be expecting price increase next year because it's about one of the most consistent indicators in the real estate market here in Silicon Valley, as we have a significant run up in the prices. And it is my belief that occurs because the buyers come out onto the marketplace before the sellers do, giving a huge increase in demand without the supply. And so buyers go crazy. But also notice we have this overshoot every year. So you don't want to be buying in second quarter. So if you're going to buy early in 2025, you want to buy as quick as you can. You don't want to be buying in the second quarter because that's sort of when prices are the peak and they typically come down. You can see there, are a couple exceptions, like 2023 was an exception because we had come down so far in 2022 that we just climbed up. Also, 2020 was an exception with the huge demand from the pandemic, as well as 2021. So you have 3 out of 11 years that are exception, but every other year you go up, and there's a clear expectation of why those 3 years were exceptions. Here's looking at the monthly payments for the cheapest 10 percentile, the typical median priced home in Silicon Valley, and the most expensive 90%. It goes through a formula estimating property taxes and insurance and using an 80% loan at the federal average rate. So you can do better than these payments, but it shows that the typical buyer is coming in with a mortgage payment of just under $12,000, assuming an 80% loan. The next three series of slides are sort of the same concept, where I look at a weekly distribution. The purple line is the current distribution, so you can see that we're the slowest data that you'd expect, basically getting close to it. The purple line is where we're going to start off this graph. We're going to start off a year ago, so the market is cooler right now than it was a year ago, and this is for marketing time. And you can see there's a break point right here at 50%. For the first 50%, they're so close together, the data really isn't very valuable. So it's only this right-hand 50% of the data that's useful. And that's why I look at the 75th percentile. Yes, it's the third quadrant, but it's also the middle of the median of the meaningful data. And so the number's much higher this year. It's up here somewhere around 48 per days to sell 3/4 of the properties. And, a year ago, it was down here somewhere around 35 days. And so what we're doing is we're going to step through and we're going to jump roughly a month at a time, which is either 4 or 5 weeks, trying to keep the day of the month as close to the same as I can. And then when we get to 3 months ago, that's the same as 13 weeks. I then jump to weekly data. So here we go. You can see the data is already improving. There's the peak of the marketplace. Now it bounces around for a while. And there's a unusual slow, and then it speeds back up again. And that's probably associated with a holiday. I didn't pick up what date that was. And now you're sort of slowing down at the end of the year. There's a big slowdown and then an increase. So that could have been Thanksgiving. And now we're coming up to the current. There's last week and there's this week. So from last week to this week, there's a huge shift. And basically, there's been no new listings coming on the marketplace because of the holidays. And so the homes that are selling are tending to have 7 and 14 days more marketing time, which in Silicon Valley is a huge increase in the marketing time. I would actually expect, based on past history, that fairly soon this purple line's going to turn around. Now, my comparison was from jumping 4 weeks or 5 weeks forward, so I don't know what's going to happen in the near week. Here's now doing the same concept on average price reductions. You can see that this year on the purple line, we're taking larger or more frequent or a combination of more frequent price reductions. And you get notice that I'm only going to 17.5% of the sellers. So I'm ignoring 82.5% of my sellers, and I'm ignoring the 2.5 that are taking the largest price reduction because a lot of times that's data error and really isn't meaningful. So I'm only looking at 15% of the marketplace that's skewed to one side. So it's typically not what people would look at market wise, but the data is very well behaved actually. So there you can see we're coming up to right there's the least amount of price reductions. Then you can come up and accelerate. And basically by 5 months ago, we were basically at the summer plateau where the market had already overshot and come back down. And we're staying there until now we're at 8 weeks ago. There's 7 weeks ago, 6, 5, 4. Now we're starting to move. There you move 3 weeks ago, 2 weeks ago, last week, and then this week. So you can see that the market really does hold on and then really dives at the very end of the market as far as seller price reductions. And I think what is happening is sellers are waking up and saying, hey, if we want to sell this year, we're really going to have to drop our price to get the buyers in as the end of the year rapidly approaches. Now we're looking at the overbidding. So we're flipping over and sort of looking at what the pressure buyers feel, sort of the competitiveness that wears off on the buyers as they're out there trying to buy properties. And this would have been the hottest week we ever had, which was basically the end of March of 2022. The coolest week we ever had, which was back on November 30th of 2021, right after the World Trade Center. And when I say right after, yeah, the World Trade Center was back in September, but we froze for several weeks, and then it takes 5 weeks for the typical escrow to close, and that's why it was the end of November where we had the least amount of overbidding. But stepping through, there's sort of the least right there. So in one more week, which is actually 4 or 5 weeks, there's the peak of the marketplace. Then you currently cool down. And again, the reason why we have one more 5 week, 4 or 5 week period on this is because that's roughly the length of duration of the escrow. So the market is sort of at the bottom right now and about ready to turn, but we don't have overbidding data until 4 or 5 weeks after the escrows close. I'll also point out that earlier, when we get into the February, April, May timeframe, when the market's on fire, that 4 or 5 week delay of escrows gets shorter because one of the things buyers do to try to be more competitive is they shorten the duration of their escrow from 4 and 5 weeks to 3 weeks, which is about the fastest you can close with a loan. If someone has cash from a refi or from stocks or anything like that, then they could close in a week with no problem. Now what we're doing is breaking out and looking at the three components, the three counties that make up Silicon Valley. You have San Mateo County down here on the orange, then you have Santa Clara in the blue, and Alameda County in the gray. So since you're looking at the number of the raw count of the active listings, the size of the counties does matter because the larger the county is, the more inventory they're going to tend to have. But you can see that Alameda County and Santa Clara County are roughly fairly close together historically, both before and after the pandemic. So their current vertical separation, with Alameda County having about 570 listings and Santa Clara County only having about 320 listings, is a fairly significant difference compared to where they normally are. San Mateo County is sort of at the lowest level, but they're all at their sort of lowest level, when you come back and look at it, but you expect it to be at this time of the year because of the holidays. The biggest one is Alameda County is also below their lowest level. So all three counties are below their lowest level of inventory. Now we're looking at the number of offers, and here Santa Clara County and Alameda County normally perform roughly the same. They're performing roughly the same now. So with Santa Clara County having noticeably less inventory and roughly having the same amount of offers, it's going to have a faster marketplace. That is, Santa Clara will have the faster marketplace. And here you have Santa Clara with the fastest market time of 24 days. That basically means in just over 3 weeks, Santa Clara County would sell out all their existing inventory at their existing rate of sales. San Mateo County in the orange and Alameda County in the gray are going to take right around 35 days. Looks like both sides, looks like 34 and 36 days, respectively. So basically, right at 5 weeks to sell out their inventory. So going from 3 weeks to 5 weeks is a significantly different marketplace. And that's why I want to look at the data here on a county level. And then later on, we'll look at it even on the micro market areas within these three counties. Here's marketing time for the 75th percentile. You can see Santa Clara is the fastest at 32 days. San Mateo County is next at 50 days. And Alameda County is in third place at about 55 days to sell 3/4 of their inventory. So Alameda County is at almost 2 months, and Santa Clara County is barely over a month. Here's your price reductions. Santa Clara County is doing the least amount of price reductions at about 0.6%. San Mateo and Alameda County are almost right on top of one another, and it looks like it's about 1.7% of a price reduction. So not large numbers, but again, remember the vast majority of the sellers do no price adjustments whatsoever. Here's the frequency of price reductions. Santa Clara County is coming in at 14%. San Mateo County is coming in at, it looks like 23%. And then Alameda County is coming in at just under 25% of the sellers are doing price reductions. So there is quite a bit of difference. I would say Alameda and San Mateo County are pretty close together, somewhere around 24%. So 1 in 4 sellers are doing a price reduction. And Santa Clara County is about 1 in 7 sellers are doing a price reduction. So not quite half, but getting close to half the number of price reductions. Here's the overbidding. So Santa Clara County has the least amount of overbidding, which is sort of surprising, and probably equally surprising is Alameda County has the most overbidding. Very close together, basically right at 5% overbidding. Santa Clara is probably at 4.5%. San Mateo County is probably at 5%, and then Alameda County is probably approaching 5.5% overbidding. But it's sort of odd that the slowest county has the most overbidding. This is the frequency of overbidding. And again, the order is sort of unusual, but in concert with the previous slide, with Santa Clara County having the least amount of overbidding than San Mateo County, and Alameda County, which again was one of the slowest counties, was the slowest of the three counties, having the most frequent overbidding. So it's got the largest magnitude and the largest frequency of overbidding. Here's the long-term appreciation. Santa Clara County comes out on top here at somewhere around 95% appreciation since the last 9 months of 2015. San Mateo County has the least at about 55% appreciation, and Alameda County is somewhere around 62% appreciation since the 2015. Here's the long-term prices. I put in the horizontal line so you can see that we're below the 2023 and the 2022 and the 2021 pricing for Alameda County. San Mateo County is below all those 4 years as well. Santa Clara County is sort of the exception. It's below the 2024 pricing, but it's above the 2023 pricing. And it's basically above the 2022 pricing, except for a short period of time. And it's definitely above the 2021 pricing. So Santa Clara County has seen the highest rate of appreciation and the least amount of depreciation in the last several years. Basically, prices came up and they've been flat. Santa Clara has been growing, but Alameda County in the gray is basically flat, and San Mateo County in the orange is basically flat, where Santa Clara County has had a slight growth to it. So, except for this year in Santa Clara County, prices are at a record level high for Santa Clara County. Here's the same information on regular paper for those that prefer. And this is the estimated payments for the three counties. And I didn't point it out on the price slide, but Santa Clara County is now slightly above San Mateo County, and you can see the huge change. So we can go back and look at it. So you can see the huge change in San Mateo County pricing basically 2 weeks ago. coming down and now being below Santa Clara County. Not does happen every once in a while, but it's only happened since the pandemic. Here's the estimated payments. Now we're into micro market areas. I like this because it gives you an idea that the real estate market is not really homogeneous. So it does really matter where you're looking to buy the real estate. Real estate is very local. This is simply looking at the shortage of inventory. The redder the color, the shortage of the inventory. The bluer the color up here in Redwood City and also Foster City, very small micro market area. There's actually a surplus of inventory. Here's the offers. And so across the board, you can see there's a lack of offers since everything's blue in color. The bluer color, the bigger the lack is, the more pale it is, the more normal it is. So Livermore, Alameda County, and I only have regional data for the first three data slides for Alameda County. But you notice your Saratoga Las Gatos has actually got 24% more sales happening than they typically do. Here's the turnover rate. So Saratoga Las Gatos has one of the fastest marketing times because that extra 24% of offers being accepted with probably less inventory than normal. But also your moderately affordable areas down here in Santa Teresa, Blossom Valley, North Valley, and Milpitas having a fairly quick turnover rate. Your affordable area of Central San Jose, South San Jose, and East San Jose is much slower than it typically is, along with Redwood City, Foster City, and Morgan Hill. So you can see there's a lot of areas that are white that are roughly normal marketplaces as far as speeds. Now, normal on speed may be still fast. And, if you look at Alameda County, it's at 90% of the speed that it normally is, so 10% faster, but it has no color because up here is my index, from 87.5% to 12.5, 112% is no coloring whatsoever. So basically a 25% range on each side of 100% gets no color. I also have Silicon Valley wide data here, so you can see it's at 91%. And then I have the three counties. Santa Clara County broken up into 7 different micro market areas, San Mateo County broken up into 6 micro market areas, and Alameda County broken up into 7 micro market areas once we get into this next slide. And this slide is simply looking at the speed of the marketplace as measured by days unsold inventory right now. It's no longer comparing. So even though the market was sort of normal to, some cold spots and some hot spots, when you look at just the normalness of the marketplace, the market's still fast paced. You go out here to Livermore 21 days, and 21 days is a fast marketplace, which is why it's pink, even though back here, compared to its normal, it was basically doing normal, and it's at 90%. So it's only 10% faster than normal. So the two slides are slightly different. This is sort of the speed of the marketplace. The other one's doing a check compared to how it's normally doing. And then you can see that the expense varies in San Mateo County, which would be things like Atherton, Menlo Park, Woodside, Portola Valley, is actually blue with 88 days of unsold inventory, which is a large number, even though it isn't for much of the nation. Here's your marketing time, which is probably my simplest to understand metric. Simply, how long does it take 3/4 of the sellers to sell? You can see in Cupertino, in 9 days, so just over a week. So a seller that comes on the market, say on Wednesday, and looks at offers on Thursday or Tuesday to Thursday, something like that, just 9 days on the marketplace, 3/4 of the sellers are selling. And that's the longest of the 3/4. That means a lot of those 3/4 of people are selling in less than that. They're selling in 7 days and 5 days and 4 days. Some of the slowest days on San Mateo County coast, 153 days. I mean, you're approaching 6 months for 3/4 of the sellers to sell. And then you drop down, fairly drop it. Next is Oakland at 81 days, Los Altos at 76 days, Atherton at 66 days. So it allows you to see the variation just by looking at the colors and then coming over in the key, or just looking at the key, which is sometimes easier to do it because you have no background shading that sort of skews the colors. And you can see that, right now in Mountain View, the market is much hotter. I guess this is actually Cupertino area here, much hotter at 9 days than anywhere else. Here's the ask price adjustments. So where are sellers taking the largest price reductions? They're taking them on the San Mateo County coast. and they're taking them up in Oakland. They are not taking them in Fremont. They're actually increasing the price by 1% in Fremont, so it's saturated red. So you can see you have from price increases to price decreases. And, San Mateo County Coast, almost a 9% price reduction. That's huge. The sellers do their homework. They don't want to stay on the market. They price their home. If they have to sell, they price their home at market value, and they're still taking almost a 9% price reduction after they go on the marketplace. Here's the frequency of those price reductions. San Mateo County Coast, almost 80% of the sellers are having to reduce their price before they get the offer in the door. That's huge. Oakland is the next closest at half that, and under 41% of the sellers are reducing their price. Then you come into areas like Cupertino, where only 6% of the sellers are reducing their price. Campbell, 7% of the sellers are reducing their price. So there are huge difference between 7% and 80% of the sellers doing price adjustments. You go to Foster City, again, very small micro market area, but no sellers are doing a price adjustment. Here's looking at the overbidding. So where are buyers feeling the most pressure? It's up here on the island and city of the Alameda, along with the city of Berkeley. And then after that, most of the area is sort of pink in color. It's just a matter of what shade of pink. Pleasanton is zero overbidding, so it's white in color. Then you get into Atherton, which is, a little bit of a negative number, and so it's also white in color. You can see the index varies from each metric and is at the top of the graph for you. Here's the frequency of overbidding. So very little overbidding in Pleasanton, as well as the expensive areas in San Mateo County. A lot of overbidding in Foster City and Fremont and the island of Alameda. Island of Alameda, 74% of the sellers are getting overbid. Foster City, it's 100% of the sellers are getting more than their asking price. Here's the appreciation. Now, here's something really telling. Look at where the appreciation center, look at where the red is. It's sort of the little bit close in, but outlying areas of Silicon Valley. Your areas that used to be highly desirable because they were close to the commute has done the least well since the pandemic. Because remember, this is going back to the last 9 months of 2015. So a very telling slide on where the appreciation has happened over the last 10 years. Here's your sold price. And instead of following the median number, which is the middle number, as most people do, I also add in the 10 percentile, the number on the left, and the 90 percentile. This way you have a price range as well as a target. So if someone was looking at $1.5 million, South County would be very fruitful for them. The affordable areas of East Central, South San Jose, Milpitas, Blossom Valley would be. But when you start getting into Campbell, the median is 1.9 and the cheapest 10% is 1.4. So if you're going to spend 1.5, yeah, there's going to be some percentage of those homes available for you, but not a whole lot. And that way you just, you get some idea where you can find or how often a property in your price range is going to come in, depending on what metric area you're looking in. Here's a summary of all the slides. You can start off on the left-hand side in the different micro market areas, and the nomenclature I try to keep the same. The numbers are identical, so pick the micro market area number, and then you can follow it across all my slides. You come over here to your payment that you want to have, or the price range that a lender says you can qualify for, and then pick your micro market areas that are going to work for you, and then come across and see what the micro market conditions are. You have areas like the San Mateo County coast, where it's basically blue in color and very cool marketplace favoring the buyer, or you go into an area like Cupertino that's basically red and favoring the seller. So there's a huge difference within Silicon Valley, and it's important to know what the conditions are in the area. Yes, you didn't rely on your own experiences out there, but this gives you an idea from the get-go on what to experience in the different areas. Across the board, there's a lack of inventory, but there's also a lack of offers, as you can see. And then the speed of the marketplace, even though there's a lack of both, the market overall is moving pretty quickly. Here's a summary of either Silicon Valley for the raw data, Santa Clara County, San Mateo, and Alameda counties, the different indexes. The number of new listings is really dropping off as you'd expect it to do. Starting as early as next week, I'd expect that number to start off In 2 weeks, it will be up significantly, but I would expect some increase next week. With New Year's being on Wednesday, there may be people coming on the market that Thursday and Friday. So a week out, starting Wednesday, I'd really expect a lot of new inventory to be hitting the marketplace. This slide is up here only to show the lack of offers. You can see the record low year was 2023 at 1,014, then 2022 at 1,106. This year is at 1,132. There's a very good chance that this will become the second worst year. And the reason that can happen is this data gets updated for 13 weeks and transactions fail. Once an escrow that it starts fails, it no longer counts in the 1132. So all the escrows back here that were going to fail have failed by now. And so now we're at the point where this number is only going to go down. Yes, there could be a slight increase as late as next week where some people report late transactions, but the number usually of failed transactions is greater. So I'd expect this number to start going down next week. So right now, there's 2 years that have less offers accepted out of the last 10. 2007 outperformed this 1132. So we're currently even having the third worst year for the last 25 years. You can see up here, 2007 had fewer transactions, so we were the fourth lowest year. Now 2027 has more transactions, so we're the third lowest year. We've been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area and 5 regions, 13 counties shortly. The blue URL takes you to the archive on YouTube. You can also type in the shorter green root URL that will take you to the same location. If you use green root URL plus the year 2025 starting next week, you can join the live presentation Saturday morning at 9 o'clock. If you put in the green root URL H, the month, the year, month, date code, you get the handout. It's 67-page PowerPoint slide sent to you electronically from a download. And then if you want any specific past episode, you put in the green root URL, the year, month, date code for that. I'm Richard Calhoun, real estate broker with Creekside Realty. My email address, my phone number, working with buyers or sellers in Silicon Valley doing single agency transactions. Please considering subscribing and liking the videos that you watch. Appreciate it. Let me see if there's any questions. Don't see any unmuted mics. I'll go on to the Greater Bay Area, 13 counties, 5 regions next. So in the Greater Bay Area, we've broken it down into 5 regions covering 13 counties. Getting onto the data, this is looking at inventory. You can see inventory is rolling over and going down in all 5 regions, which is very common at the end of the year holidays. Here is looking at the number of offers. I did make the Silicon Valley purple line here much thinner, and that was so you could see that Central Valley in the yellow has reversed its increasing abnormal trend and has now actually followed the more normal pattern of decreasing number of offers as we get to the end of the year. North Bay is also going down. You can see that Silicon Valley is somewhere right around 1150, and so is the North Bay. The Central Valley area is a little bit higher at about 1,275 listings. And then the Central Coast and cities are much smaller at just over 225 offers. Here's the days of unsold inventory, so the relative speed of each of the marketplaces. We have Silicon Valley at right about 32 days of unsold inventory. And then comes the cities at about 46 days. Then you're jumping up to the Central Valley at 60 days, up to the North Bay at about 67 days. And finally, coming in at the slowest is the Central Coast at about 90 days to sell their existing inventory. Now, looking at marketing time, this is probably the easiest to understand metric. It's simply how long is it taking 75% of the sellers to sell their properties. So 75% of the properties are being sold in less than 48 days in Silicon Valley. Then comes the Central Coast. You have the Central Valley right there at 60 days. North Bay is about 72 days. And the slowest area, the area that's taking the longest marketing times is San Francisco and Marin at 78 days to sell 3/4 of their inventory that does sell. Here's price reductions. The least amount of price reductions is Silicon Valley at just about 1.2%. All of them are increasing price reductions at this time, except, you have the cities reversing going up just this last week, but that's just fluctuation. The trend is clearly down in the cities looking at the orange. In fact, it's the most dramatic. The Central Valley is next at it's about 98.3%, so about a 1.7% price decrease. Then you have the North Bay coming in at about 2.4%. So price reduction. Then you come down to the cities at 2.7. And finally, the most price reductions is the Central Coast at about 2.8% price reductions on average, which is significant when you look at what frequency is. And that should be the next slide. So the frequency, only a third of your sellers are reducing the price in the Central Coast. And yet on the previous slide, we saw it's almost 3%. So that means the sellers that are doing the price reductions on average are taking about a 9% price reduction, which is pretty significant. So if we look just at the seller frequency of ask price, it's most frequent in the Central Valley at about 38%. Then you have a two-way tie for the cities and North Bay at about 34%. Then comes the Central Coast at 32%. And the area that's clearly having the least price reductions is Silicon Valley at 20% of the sellers. 1 in 5 sellers are doing a price reduction. Here's the magnitude of the overbidding. So now we're flipping over and seeing what the buyers are doing after looking at what the sellers are doing. The cities has the most overbidding at about 5.5%. For Silicon Valley, it's right at 5%. Then you drop down to North Bay, it's just a hair over 100%. And then a two-way tie for last place with Central Valley and the Central Coast being about a 0.5% price reduction. So 0.5%. So 99.5% of their asking price. This is the frequency of overbidding. The most frequent overbids are in Silicon Valley at 58%, followed by the cities at 54%. Then you jump down to North Bay at set 40% even. Then the Central Coast at about 37%. And finally, the area with the least amount of overbidding is the Central Valley at 32% or 34% overbidding. This is long-term appreciation. So you've gone from the area with the least amount of overbidding, the Central Valley, it shows the most amount of appreciation. The appreciation in the Central Valley has been about 88%, moved down to Silicon Valley coming in at about 76%, followed closely by the Central Coast at 72%, North Bay at about 66% appreciation, and in last place, a distance last place, is the cities in San Francisco and Marin at 32% appreciation since 2015. This is the long-term pricing, so you can see that San Francisco, the cities, is just a tad above Silicon Valley, about 1550 for both of them, maybe 1525 for Silicon Valley and 1550 for the cities. Then you jump down to the Central Coast at 1.1 million, then all the way down to the North Bay at 800,000, and the Central Valley is about 550,000 for the median sold price. Here are the corresponding monthly payments, assuming an 80% loan and using a reasonable estimate for property taxes and insurance. And with that, here's the numbers of the metrics across the top. Each one of the 13 counties down the left-hand side. I do also have Silicon Valley, which is somewhat meaningful because the 3 counties are somewhat together, but Santa Clara County is doing the best on most of the terms out of the 3 counties. So even that isn't true, that they're all the same. The Bay Area data is on here mostly to compare it to the media because that's what the media talks about, but it's really a garbage number and you can pick pretty much any metric you want to pick. Let's look at frequency of overbidding. It's 51% for the city and that for the Bay Area, and that goes anywhere from a low of 28% overbidding in Sonoma all the way up to a high of 70% overbidding in San Francisco. So to say that it's 50, yeah, that's sort of close to the average of the 2 numbers, but it really doesn't tell you what's going on in any given area. You got a couple areas down here right around 30%. You got a couple areas right around 45. You got a couple areas right around 60, and then you got one area in San Francisco at 70% appreciation. And you can do that with pretty much any metric and see that they're just all over the place. And with that, we're finished up. This is the different chapters. There's a link in the description below to whatever chapter you find most interesting. I would appreciate a like and a subscribe. And with that, not seeing any unmuted mic, have a great week. Take care. Bye for now.